Hello and welcome to the MoneyMagpie Invest webinar on how politics affects the gold price. Now, firstly, before I start, boring I know, but I have to say that nothing that is said today should be taken as financial advice. It's financial information. As you know, you go and do your own research. And if you're watching on YouTube right now, because this is being recorded, make sure to subscribe, follow, comment. We're always interested in the comments. And I just want to introduce my fabulous panel. Firstly, we have Alistair MacLeod. If you'd say hello, Alistair.
Hello.
Alistair is a former City insider and now the author of a very popular Substack, the Alistair MacLeod Substack. Does what it says on the tin. Alistair MacLeod Substack. I do recommend that you sign up to that. It's very, very informative. We also have John Butler. Say hi, John.
Hello?
John is a former manager at Lehman's and Deutsche Bank, and is also the author of The Golden Revolution Revisited, which you can get on Amazon. And he also has a Substack called Amphora. We have Tim Price. Hey, hi, Tim.
Hi, Tim.
Inter- International man of mystery who refuses to have his camera on.
I don't have a camera.
Oh, yeah, okay. Yeah, it doesn't have a camera. Now, Tim is co-founder of the wealth managers Price Value Partners and big fan of gold and gold miners. Now, we were supposed to have lovely Harry Thorne, who is the CEO of Bullion Club. Sorry, I was going to say something else. He's a CEO of bullionclub.co.uk. Sadly, he's hors de combat right now, having just come back from holiday, not doing too well. So we hope that he gets better very soon. And it's a shame not to have him because he knows a lot, and they are sponsoring this whole website webinar. So very sorry not to have him. And we're hoping to have Cameron Parry, the founder of the gold bank account Tally Money as well. So when he comes along, we'll say,
Yeah, I'm here.
"Oh, you're
How's
here, you're
everything?
here, Cameron. Oh,
Hi.
fantastic. So great to have you, Cameron. Cameron is the founder of the gold bank account Tally Money. You put your money in, it's immediately invested in gold. So we have a really expert panel of gold specialists. And this is all about how politics affects the gold price because we know it does big time. The more volatile the world political and economic conditions are, frankly, the better for the gold price. So let's have a look at what we think is coming up. And I'd like to start with you, Alistair, because you and I did a podcast a few weeks ago, which is on the Money Magpie YouTube channel. Very, very popular podcast. And it was based on the idea was based on something you'd said, that you felt that we're in the same sort of position as we were in 1929. We're looking at a crash imminent. Do you still feel that?
Yeah, very much so. I mean, the commonality in 1929 and the position now is that we are at the top of a credit bubble. Now, calling the actual top is always a bit of a fool's game because these things very often go on for quite a lot longer than you might think reasonable. But there is absolutely no doubt that we are in a credit bubble. And if you find that hard to understand, just look at the debt, because debt is the other side of credit. Debt is absolutely enormous. It is, I mean, it's far larger than anything we saw in 1929. The run up to the 1929 crash, of course, was the Roaring Twenties. And if you think about it, the Roaring Twenties were basically a credit bubble. You know, everybody was, making lots of money and it was all lovely, and credit was being funneled into assets. So that's the same thing. Now, the other thing which is very, very worrying is that at the time of the 1929 crash, Congress was considering the 1930 Smoot-Hawley Tariff Act, which was signed into law the following April. And what have we got today? We've got a credit bubble, enormous credit bubble, and we've got Trump's rather unpredictable tariffs. I mean, it's the combination which is exactly the same, but this time it is much, much bigger. And so the consequences, I think, are at least going to be at least as bad as they were in 1929 to 32, when the Dow lost 90% of its value, just under 90% of its value. And as well as that, 10,000 banks went bust. That was actually what the contraction of credit was, not as Keynes and and Fisher and all the rest of it. I mean, they saw the contraction of credit as being, the real sort of lethal thing, and therefore you had to get off the gold standard in order to puff up credit. But I mean, the credit was disappearing simply because everybody was going bust. So the situation is very, very similar.
Yeah, very similar. So, what it also seems to be similar to is the 1970s. And Tim, I know this is one of your themes that we're basically in the 70s again. Do you feel that
Yeah,
still?
it feels that way to me. And I'm too young to remember the 70s very well. Because I was a kid. I was born in 69. But the gold and silver price, I think in the 1970s went up by 22 times. So anybody, I noticed that on the chat, a lot of people are asking if they've missed the boat. I think this rally's really only just got started. But it's important to remember that this is not so much that gold is rising, it's that all fiat currencies are devaluing in plain sight. So to echo what Alistair said, it is a problem of debt. There is too much debt in the world. It's a predicament rather than a problem. Problems can be dealt with. Predicaments can only be handled. So it's an open question as to how this one gets resolved. The single biggest problem that we've had politically is, I'd say, is the fact that in freezing Russia's reserves, foreign reserves after the invasion of Ukraine, the West basically sent a signal, and the US sent a signal that it can no longer be trusted. So a country with $37 trillion of national debt, growing at $1 trillion every 100 days, I think now, sent a signal that basically to all, whether they were aligned or unaligned countries, sent a signal that basically do not buy US assets because on a whim we will freeze them. So I think been the single biggest driver to what's happened to the gold price over the last few years. And it's a central bank development, but it's going to I think the reason the rally will continue is because private investors have barely even got involved. UBS, the Swiss bank UBS, published a study recently showing that as their analysis of family offices typically have 1% of their capital allocated to gold and less than 1% to commodities. So I think we're literally repeating the 1970s all over again.
Interesting. And it's a good point, actually, John. This is a question, as Tim's pointed out. Kevin Lay has said, now that the gold price has broken 3K, has it topped out? I'm guessing you don't think so either.
No, I believe, and I believe Alistair and Tim both agree with this, that the gold price has risen a lot, but really this is largely a story of fiat currencies being basically downgraded in the eyes of investors as reliable, credible stores of value. It's a bit of both. It's a bit of both. For example, the mention of freezing Russia's foreign reserves. That's just one step among many. Russia's been under sanctions in some form since 2014, when it re-annexed Crimea. And and so gold has been sort of de facto remonetized at the international level as a way to avoid sanctions, because those sanctions have become ever more widespread and heavy-handed in the subsequent years, especially, of course, following Russia's invasion of Ukraine in 2022. So there's a lot that's going on here. There has been a shift in the demand function for gold. It's got multiple aspects to it, and none of those aspects shows any sign of being resolved. The debt pile continues to grow. The temptation to devalue currencies to make that debt more serviceable continues to grow as a very real risk. The sanctions are still in place. The confiscation of assets is a very real risk. And all of that points, in my opinion, to a still higher gold price from here.
Mm.
Yes, and Cameron, I mean, your whole product is based on investing in gold, and it's done, savers have done very well over the last few years with you. Do you think that gold has a long way to go as well, or is it going to just tip out a bit, particularly if the wars that we're sort of looking at the moment, Israel, Ukraine, if those are resolved, which is not likely in my opinion, in all honesty, but if those are resolved, do you think that would actually bring the gold price down or flatten it out?
Well, there's to the first bit, we're just about facilitating people to own an asset that they can easily understand and is universally acceptable, that they can own that directly and use it for money as they would the local fiat currency, for the reasons that some of the other guys are saying, that fiat currency is not something that can be relied upon. It is devalued by design, and it is probably going through a structural change now that we're 55 years into a monetary experiment of having it not anchored to anything, and having those people who make decisions about its flow not being accountable to the consequences of those decisions. So it fully lacks accountability, and we've been 5.5 decades of this, and we're seeing it change quite a lot. But as far as the gold price generally, if you ask me how the rate of rise, I think that's a debatable point. But over time, it will continue to rise, because the inverse of it is it's reflecting inflation. And inflation's always baked in. So the inflation we suffered last year, it's not like things go back to zero and then we just have new inflation this year. We have inflation on inflation. So you get this kind of compounding benefit or compounding effect. And the same with the gold price. I mean, it's risen very dramatically in the last couple of years. I mean, it's up basically 100% against the pound. I don't expect that to, continue being the case necessarily. But on average, prior to that, for the last 25 years prior to that, it was averaging over 10% a year. So it'll move, the rate of rise will move around, in my view, but it will still, over time, be rising, because the thing it's being measured in is being devalued, and devalued by design.
Yeah, like you've been saying, exactly. Alistair, what do you think about, because I've had a couple of questions from readers about the wars, and it said if the wars are sort of not happening, or if they sort of are, if peace breaks out there, will that mean the gold price won't go up? Or are there too many other factors that are pushing the gold price up?
I think that looking at the wars is actually looking at the wrong thing. The real problem is the debasement of fiat currencies. It's something which has been going on since 1971. And fiat currencies always run out of time. And I think what we're seeing is the end of the fiat currency era. It's now coming to an end. And it's really being destroyed by, the collapse of the credit bubble. I mean, that's the way in which debt gets wiped out. It gets wiped out not by the numbers of debt being reduced, but by the value of debt being reduced. Now, what that tells us is that the value of fiat currencies is on the edge of a precipice, and they're going to fall very substantially. What happens then, basically, is that because gold's value is constant over long periods of time, you will see the price of gold appear to rise, but actually what's happening is that the value of the fiat currencies is declining. And that's the real thing that's doing it. I think wars are a bit of a side issue. I mean, obviously there is an effect, but there is also something else coming into it at the moment, and that is lack of liquidity in the paper markets. The amount of stands for delivery on COMEX are really quite remarkable. Remember that COMEX is just a futures market, and the idea of the ability to, let us say, to turn a contract into physical was only really to tie the contract to the physical price on expiry. I mean, it was never intended that it should be used as a mechanism to deliver gold. But when you see that so far this year, and I keep the figures assiduously, so far this year, over 1,000 tons of gold have been stood for delivery. Now, it doesn't necessarily come out of the COMEX warehouses, but what it does is the ownership changes into people who are basically hoarding it. Now, so if you look at COMEX, that is in effect 3 times the supply of the Chinese mining system, gold mining system. It is that, I mean, COMEX is now the largest gold mine in the world in terms of supply by miles, absolutely miles. As I say, 3 times more gold is coming out of COMEX than there is coming out of China, out of the Chinese mining system. So this is actually leading to a liquidity crisis in precious metals markets, which is also being reflected very, very much in silver at the moment. So I think that's likely to drive the value of gold, if you like, its own value, as it were, up. maybe temporarily. And that's a situation which, if it is resolved, might lead to a pause in the rise of the gold market, gold price. But basically, what we're looking at is a collapse in the value of fiat currencies. And it ain't stopping soon. It's not going to stop at all, so far as I can see. It needs political will to do that, and that is completely absent.
So just to follow on that thought, because I think Alistair's completely right. What we're witnessing is a structural change because there's an end of a chapter where money was this certain thing that was globally used, and the USD was the hegemony, the global currency around the world. But the US won't want to lose that, and they have, as somebody else pointed out, they have lost a lot of credibility with what they did to Russia. So, but who's got the political will to make, seismic resets in the world at the moment? Well, the US president is that animal. And I think the big thing that I predict is mathematically fiat currency is doomed. This debt bomb has to go off. It has to be reset. So, and I think what we'll see within Trump's final 3 years is he'll reset the US dollar at a percentage to gold that they'll get revalued out of Fort Knox so that the world can trust the US dollar again and they will be the leader. And one of the reasons he'll do this is because you need to be prepared to be hated by at least half the population to do it, and he won't care about that. He wants to be, he does have a pretty sizable ego, it would seem. He does want to be a significantly consequential president, so he'll like that. But it needs to be done. And I think one thing that he would consider, what if somebody did it after him, like the next president? They'll get the credit for being this giant, So I think there's a good chance we will see this all reset with the US dollar anchored to a percentage in gold. There is some speculation around whether Bitcoin will form part of that, but I don't really see that as the case. And it is because this 55-year-old maths experiment is coming to an end. And the debt net situation needs to be addressed.
Which makes me think, John, something that you've said a lot, and your book essentially is about it, is that we could have the gold standard coming back. I mean, what Cameron's saying is, not exactly gold standard, but bringing in gold to the dollar. And of course, we've got all the central banks, not the Bank of England, but major central banks now hoarding more gold than dollars. Do you see this as potentially ushering in a new gold standard?
Well, eventually, I think that's where you get to. But I don't know exactly how that's going to come about. In my book, I offer up several scenarios for how gold could be remonetized at the international level. And then, of course, it would be a decision for individual countries to make whether indeed they set their national currency systems on a strict gold backing. And one possibility that I do present in my book is that the US decides almost unilaterally, but presumably amidst some degree of international pressure, that they are going to return the dollar to some sort of gold peg, as was the case under Bretton Woods. And then I run through the numbers regarding what gold price would be implied if were the US to have the same degree of gold backing today as they did when Bretton Woods was set up in 1944. And you end up with a gold price on the order of magnitude of $40,000 to $50,000 is what would be required for that to be seen as a credible degree of gold backing. So, you can't rule it out. It could happen that way. It could happen in a very different way with China, India, the other BRICS countries acting in concert to come up with their own gold-backed currency for use in international trade. And it could happen in a very chaotic way, where one country after another is dragged kicking and screaming back onto some sort of gold standard because no one's willing to accept anything that's not gold-backed anymore. Who knows? All of the above are possible, but they all point to a significantly higher gold price if that is indeed where we're going.
And this brings me to a really good question from James T, which is he's wondering, what do you think is the possibility that our governments will control or limit gold trading? I'm thinking also about, of course, in America. Actually, I'll go back to you, John, because I know this is something you've spoken about. In America, back in, what was it, the 20s, 30s, you had to give in your gold. But that was tried back in, a long time ago in this country, and it didn't end well for the king, did it?
No, it's quite interesting. On every occasion that gold has been confiscated by the British Crown, whoever was wearing that crown at the time lost their head or their life in some other way. So you really don't want to go there. I do think that's unlikely. I think it's unlikely that you get such a heavy-handed response to this. Depends on the country, perhaps, that we're talking about here. And in the case of the United States, what you mentioned was in 1933, when the new president, Franklin Delano Roosevelt, decided the best way to come to grips with the US's deep, deep banking crisis at the time was basically to make it illegal for people to withdraw any more gold from the banks, such that the banks wouldn't have a run on their gold reserves anymore. But then conveniently, he effectively nationalized the gold stock, and then devalued the dollar versus that gold stock by some 60%. Which basically ended the deflation of the Great Depression, because that was a huge devaluation of the dollar in real terms. Now, economists to this day debate the relative merits of having done that sort of thing. I think it's unlikely that a similar thing would play out today, but you can't rule it out.
I think so. Mike Clark has also asked a question about the gold price. What does this really mean for the global economies? We've touched on this already, but Alistair, should we be worried about a recession or something similar in 2026, maybe a big crash?
Well, the collapse of, if you like, the credit bubble is going to raise bond yields. I mean, it's as simple as that. Because what bond yields represent, apart from not possession of the money, and also let's say individual lender or borrower risk, it also reflects, if you like, the lender's opinion on what the purchasing power of the currency is going to do over, let's say, a year or two's timescale. So if the expectation is that the purchasing power of the currency is going to go down, then quite simply, bond yields rise. And you're going to get that. You're going to get also the increased risk factor driving bond yields up. So what does that do? Well, you can forget the idea of cuts in interest rates. If the Fed does cut interest rates, then it's just going to weaken the dollar further, which basically means that the price of gold appears to rise. So, I mean, when it comes to recession, yeah, I think what we're missing in this is that it's not just the gold price rising. What we're also going to be seeing is all commodity prices rising, because that is actually, if you like, part and parcel of the fall in the purchasing power of the currencies in which you measure these commodity prices. And so the inflation outlook, which is, if you like, the sort of slightly ridiculous language that economists use, the inflation outlook is going to be very, very dire. I actually see a lot of parallels. We've been sort of looking at history, and Tim mentioned 71 to 81. I mentioned 29 to 32. There is another parallel which is very, very interesting, and that is what happened in Germany after the First World War. You had a 2-year period from 18 to 20 when the purchasing power of the Reichsmark actually fell quite significantly. I mean, it lost something like, I think prices went up something like 3 or 4 or 500%, something like that. Then there was a period of stability, and the Reichsmark was briefly the best performing currency of the lot. It actually went up against the gold-backed dollar. There was a boom in asset values. Stock market tripled and so on and so forth, and everybody was very, very happy, apart from, of course, the man in Main Street, as it were, or Mainstrasse, or, well, John's got the German anyway, because he got none of this benefit whatsoever. So in that sense, it's quite similar to today. And then you had from December 21 until November 23, you had a complete collapse in the currency. Now, you could fit that into the phases today because we had COVID. We then had the first wave of inflation, if you like, in other words, the fall in purchasing power of the currencies, reflecting the massive explosion of debt. And commodity prices rose actually very, very strongly. Then we had this period of stability, and we're still in this period of stability when credit was basically pushing up asset values. I mean, we weren't necessarily outside improving asset values and all the rest of it. We're not really improving our underlying economic situation, but it's basically an asset bubble. And then, of course, we get to the end of that asset bubble. And when it collapses, what happened in Germany was not only did you have the collapse of the asset bubble, but also you had the collapse of the currency, which went down with it. So we had, at the end of that, you had something like 1 trillion paper marks, Reichsmarks, to one gold mark equivalent. And I mean, this was, basically the currency just sort of wiped everybody out. So that, I think, is the danger that I see from when this asset bubble pops, and I think it could pop by the new year, and let us say over the next 2 to 3 years. I don't know that it'll be quite as quick or as violent as what happened in Germany between December 21 and November 23. But this is something which I think has got the mark of that beast underneath it.
Absolutely.
So this is a very important point. Now, we're going to get, I mean, basically, when you have bond yields rising like that, it just wipes out the debtors. I mean, and you wipe out the debtors, you wipe out the credit at the same time, because that's the only way credit goes. So, and a lot of that credit, of course, is currencies. What do the authorities do? Well, I mean, they do exactly what they did in Germany between late 1921 and 1923. And I mean, everybody's sort of criticized the German authorities, and I mean, how stupid could they be and all the rest of it? And, this is just absolutely ridiculous. But we're going to be facing the same problems. And I think that's a very interesting thing. Interesting Chinese sense.
Yes, exactly. Interesting.
Yeah.
Tim, you've talked about the Weimar Republic a lot as well. Do you feel that really is a clear and present danger at the moment?
I think we're in many respects living through something quite similar. So I'm trying to think what the word is. It's Katastrophenhauser. John may be able to correct my pronunciation, but it's what.
Katastrophenphase.
Okay. But that's crackup boom. So for people who are not necessarily aware, one of the most important economists relevant to this predicament we're now in was Ludwig von Mises, who had first-hand experience of the Weimar hyperinflation. And I think we're now in the period of the crackup boom already, because it's not just gold. Let's get a sense of perspective. It's not just gold that's going up. One of your viewers said, well, you've got other currencies. You've got other commodities going up. You've also got this big bubble in AI-related things. There's lots of stock markets at all-time highs. It would seem that the marginal investor is now desperate to convert his increasingly diminishing store of value paper money into something more tangible, whether that's stocks, whether it's property, whatever it is. So I think the crackup boom is already here.
Yeah, that's concerning. It is very concerning. I'm just looking at the questions again. Andrew Bevan has said that with people recommending 20% of your portfolio in gold, is that going to affect the gold price? I'm not aware of people. I mean, I think 20% is a good figure, but I haven't heard that recommended anywhere. But I'm guessing, Cameron, that we are the price is going to increase, as we've said already. Individual retail investors pile in, not just the central banks.
Yeah, that's right. I mean, it'd be nice to see the Bank of England pile in at some point.
Yeah.
It's a really, lack of responsibility being taken there not to hedge this situation. But yeah, if the consumer market follows, that will obviously, demand will increase. One thing that we'll, obviously we don't quite know how it all plays out, and I think the parallel with Germany in the early 20s or late teens, early 20s is probably the most accurate one. But people do have technology now and access to other things they didn't have before, so that will have some bearing on it. whether they're specifically currencies like Bitcoin or Tally, or whether they are just being able to access some other fiat currencies, particularly if there was a world leader like the US went back to some level of accountability with a proportion of gold to the dollar. Stocks, I mean, it's interesting to see how even stocks being exchanged directly between parties and just skipping the currency, through technology, how
Mm.
be interesting to see where people run for the safe haven. Personally, I think there won't be a better one than gold, but there might be other ones. But in any case, it's good for the gold price. But it kind of worries me too, like everybody else is describing it. It feels like we're in for a pretty seismic change, and I wouldn't want to be unprepared. It's
No.
definitely worth all the viewers and listeners, like they should get prepared. And it does sound scary, but you're still ahead of the curve here.
Yeah.
Get yourself sorted.
Which is good. Grant asked an interesting question. He says, as gold is priced in dollars, but we're getting returns in pounds. Is there a Forex problem here if the gold if the pound halves against the dollar, for example? Alistair, what do you feel about that? The issue with the actual the pound as opposed to the dollar.
Well, I mean, my friend Steve Hanke, who's a well-known American economist, says that he describes the dollar as the least dirty shirt
Yeah.
in the laundry. And I think it's probably an apt description because, yeah, we are on a, if you like, the dollar as a reserve currency. Everything else is pretty much tied to it. But if you look at all the G7 nations, I mean, their currencies are in at least a bad position. I mean, Japan, look at the way in which bond yields are rising there. All the central banks are technically bust. I mean, they've got debts well in excess of their equity. I mean, if these were private organizations, the directors would be in jail.
Yeah.
I mean, look at sterling. Why on earth sterling is where it is? I think the only reason sterling is where it is because you've got international arbitrage looking at the higher rates that you can get, if you like, on gilts compared with other government bonds. And look at the euro. I mean, you got France. Wow. You got. I mean, Germany is going down some sort of sinkhole, in terms of its Mittelstand, which is, I think, a great shame. I mean, they really are screwing things up very badly. Spain has gone horribly socialist. I mean, I mean, everything in G7 is basically in the same boat. And it's going to be interesting coming back to the UK to see whether these things sort of really start falling apart, particularly for sterling, ahead of the autumn statement, which has been delayed because I think they just can't get an answer to how to sort this one out. But the delay actually might well cost them because it could be a crisis before Rachel from accounts actually stands on the hind legs and tells us what she thinks. So this is, yeah, I mean, all currencies are in the same position. And as to sterling value, I personally would expect sterling to go down against the dollar, being a dirtier shirt than the dollar in Steve's terminology. And therefore, that will be reflected in a higher sterling gold price relative to the gold price in dollars. So, at the moment, sterling's about £3,000 an ounce. Looks like 4,000, here we come. And that is even without gold going anywhere.
Actually, Grant asks another interesting question. Tim, I'll put this to you about if we are in the 1970s, does that mean that we could see interest rates going to double digits? So actually, money in cash being quite useful. What do you see, Tim?
Well, put it this way, in relation to our investment business, we don't own any bonds and we'd prefer to hold bullion than cash. So I think it's important that people become very discriminating in terms of what their asset allocation is. Although we're notionally talking about gold here, the logical thing to also to examine is the prospects that are getting a good airing in relation to debt and to bonds. And anyone that has a pension that's managed by a third party, the chances are that that pension will be heavily invested in UK government bonds or gilts. Now, we happen to share the same perspective on the future of the bond market that Alistair does and that a gentleman by the name of Russell Napier does. The bond market, if you just take if you just take the yields in the US Treasury market, which is the benchmark bond market for the world, the US Treasury market is now, the Treasury bond market is now in a bear market. It's been in a bear market, i.e., yields are rising and have risen now for the last 2 to 3 years. Bond markets tend to trade in these interest rate cycles tend to last quite a long time. They're secular cycles. It is perfectly plausible that the bond markets of the world are now in maybe a 20-year bear cycle. You do not want to own bonds, full stop. So the same holds for cash and it holds for naked fiat currency exposure. The critical decision that every investor has to face is, in this environment, what do you favor? Do you favor real assets or do you favor nominal ones? And I think the answer has to be you favor real assets, be that gold, silver, miners, whatever, but you do not want to have exposure to paper assets that are unbacked by anything.
And Grant also says, will the ballooning price of gold mean that there will be a revaluation of gold in both in the Bank of England, probably about that much that we've got left, and the Federal Reserve. John, what do you think?
Well, that's just an accounting convention. That is whether you hold an asset at the lower of cost or market value. And so really, I mean, revaluing gold to its market level, uh, it has the accounting effect of making, well, let's say the US does it, because that's where it's being most seriously talked about. It has the accounting effect of making the US appear more solvent. And that additional money is money that, in theory, then becomes available to the government to spend. But even if you revalue the entire US gold stock from where it's held, around $42 an ounce, to the current price of around $4,000 an ounce, believe it or not, that would only generate liquidity to fund the US government's deficit for about 9 months. So really, it's just accounting hocus pocus. It doesn't fundamentally change anything about the debt pile, the debt problem, or anything else that we've been discussing here. So it may happen, but what effect would it have on the market price for gold? Probably not much effect at all. It could perhaps spur a few people around the margins to increase their exposure to gold, but I don't think it would change the fundamentals that we're talking about here.
Interesting, yes. Abs Haytham opines that gold will surpass over $10,000 well before 2030. Yes, I agree. I think it could easily do so. As Bitcoin will probably surpass $1 million by 2030, in her humble opinion. Cameron, what do you think? In your opinion, what are the prices going to be? Because you used to work with a crypto company before Tally. What are your views on gold and Bitcoin prices?
I mean, look, they're both measured in something that's devalued, so I think they'll both do well. Bitcoin's still a speculative asset class, so it does not, and I don't think it will in time for what's probably to come over the next 2 or 3 years, meet the criteria of really being money, which you need for proper money. You need it to be a store of value, a medium of exchange, and a unit of account that makes it understandable. And it's just too volatile. It's a speculative asset class. There is still a mainstream fear that it could digitally fall off a cliff. I mean, I don't think it will, but there's many other cryptos, and I certainly wouldn't put Bitcoin into any other bracket with any other crypto. I think it's a unique thing. Again, I'm not trying to pick what I think the outcome will be, as in a return on investment outcome, but I think it's very clear of what the outcome is going to be on whether you can be devastated by what's coming or you can be in good shape. And when a lot of other assets are cheap because people are forced to sell, you're also going to really potentially have a window to change the level of wealth in your family and for your future.
It's a good point. And Tim, I know with your wealth fund, you run Price Value Partners. You are heavy on gold and metals generally, but also gold miners, because I mean, like Cameron says, people who are in that position of holding all of these solid assets should be in a good position later on. Is that how you're thinking for going forward, or are you changing your view?
No, not at all. So I think I'm right in saying, and Alison can possibly confirm this, but I think I'm right in saying that in the 1930s, or rather, basically after the 1929 crash, gold, and I think there was a company called Homestake Mining in the States, because they went after physical gold, gold miners then were probably the best performer in the stock market. So we use bullion We use large cap miners and mid cap miners, and there's also royalty and streaming companies that you can add. So there's all kinds of ways of sort of slicing the pie. But I think the point is, I don't think I've ever been more concerned about this, let's say the state of the world, geopolitics and so on. And so it makes sense. I don't think there's any one cure for what we're living through. I think you have to be sensibly diversified, but I think you also have to be selective as well. And for us, it's abundantly clear what the red flags are, and we want to avoid the red flags. And the red flags are basically debt and fiat.
Yes, absolutely. Kevin Lay points out that platinum's doing nicely, and silver, of course. I mean, we haven't mentioned silver so far, and that it's on the up, but it's I think it looks like it's going to be even further on the up. Alistair, what do you think? Are the other precious? I mean, you've mentioned commodities generally, and do you feel that the other precious metals have a long way to go, maybe further than gold even?
Yeah, I mean, I don't follow platinum and palladium at all closely because my real focus is money and credit. And while those are sort of said to be precious metals, yeah, precious fine, but they're not money in any sense. Never have been, never will be. The key to all this is that when you look at commodity prices as a whole, they have been suppressed by being priced in fiat dollars. I mean, when I say suppressed in real terms. And if you look at, I've just actually put out a note today on base metals. Base metals are now priced in gold at roughly 20% of the level that they were in the year 1900. Now, what we know about gold is that it retains its value over long periods of time. It doesn't change. It really doesn't change. I mean, you can go back to Diocletian's edict and 300 AD, and you can see similarities in price then as there are today. So if we make the assumption that with a basket of base metals being valued at only 20% of where they were in the year 1900, then that obviously indicates that base metals are very, very undervalued in real terms. Now, we've got a declining purchasing power of the dollar on top of that. So this means that the prices of these base metals are likely to go considerably higher, considerably quicker than anybody might think in the next 2 or 3 years. But it's not just base metals. What is true in terms of suppression of prices measured in gold also applies to all other commodities. The whole of the commodity complex is wildly undervalued. And it's been wildly undervalued because of the distortions in pricing imposed upon them by the fiat currency system. This is going to really mean that, if you like, the basis of all prices, which of course commodities are, that is going to drive consumer prices far higher in the coming years. So it all fits into this scenario, if you like, of a further collapse, an acceleration in the collapse of the purchasing power of fiat currencies. So yeah, I mean, I think we are going to see platinum, palladium, silver, and all the rest of it going up. Now, silver has got the extra benefit of being, let us say, the poor man's gold. And people who might feel that they've missed the gold, the gold rush, as it were. And I mean, if you look at total portfolios around the world are assumed to be around about $300 trillion. Exposure to gold is less than half of 1%. The big banks in America are just turning bullish on gold. I mean, we had you mentioned earlier, I think it was Morgan Stanley who said 20%, you should be allocating 20% into gold. Now, this is an outlier, I can tell you, but all the other big banks have huge quantities of money under management. Like Goldman Sachs, 1.25 trillion. You've got people like Bank of America, another trillion or so. Citicorp, another trillion or so. How much gold have they got? None, virtually none. And that is all, that is all on top of the market. So you can see that the gold price is going to go considerably higher on that portfolio shift consideration. But as far as the ordinary person is concerned, they would look at silver and say, hold on a minute, we've got a gold silver ratio of 80. We're getting back to a situation where gold and silver may be more prominently money. It's wildly undervalued relative to gold. So you can see that just a little bit of demand for ETFs has basically cleaned out the market of physical. This is a crisis developing in the markets, in the paper markets. There's absolutely nothing now available in terms of liquidity to back all the silver paper that there is around, both in London and also on COMEX. Interesting times.
So we should all be overweight in commodities generally, it sounds to me.
Oh, absolutely. And I mean, Tim said, Homestake was such a wonderful performer back in the early 30s. He was absolutely right. It was the best performing stock of the lot. Everything else was collapsing around everybody's ears. And incidentally, things like property are going to do badly in this because guess what? Property is priced on, if you like, on credit. And if you're going to get rising bond yields, as I've argued, then you're going to see a collapse in property prices. We already see our property market stagnating in the UK. And in Germany, back in 1923, you could have bought really nice house in Berlin, 6 bedrooms, swanky part of the town, and all the rest of it for $100. That's what happens when you get a currency collapse.
Yeah.
Yeah, I mean, commodities are going higher and higher and higher, and they are wildly undervalued. That is where they are at the moment.
I've got another point here from Abs Haytham, who says that I believe that the BRICS economies and trading bloc will set the prices of precious metals in coming years. And it makes me think, John Butler, about the fact that it looks like the BRICS economies are creating, I think, a new currency, something to replace the dollar, but a gold-backed currency. This is what I'm hearing. Various countries, not just the BRICS ones, they're looking to create a new currency, but gold-backed. What are you hearing along those lines?
Well, there's a certain logic to that because the fact is that countries that are big, powerful, and proud don't like the US forcing sanctions on them because they might not even agree with US foreign policy generally, and they want to be independent in their foreign policies. And the BRICS have a common interest in avoiding heavy-handed US sanctions. That means you can't use the dollar for international trade. But then what do you use, right? Can they agree to use the Chinese yuan? Can they agree to use the Brazilian real? Can they agree to use the Indian rupee? Or can they agree to use a truly neutral, international, proven money, which is gold, and which none of them can print willy-nilly into existence or arbitrarily devalue, and so on and so forth. And in my book, I spend a lot of time going through kind of this game theory dynamic about how the BRICS and possibly other countries, including major oil producers, I believe, would logically find a way to remonetize gold as an alternative to the dollar and one that they can all trust, will not be abused, as it were, through whatever it might be. So that to me is a very logical possibility. Exactly how we get there, exactly how long it takes, I don't know. But in some form, that's a distinct possibility for the future.
It's very interesting, and everything that we're saying really does make it look absolutely inevitable that prices are going to go up. Andrew Bevan is saying $5,000. Other people are saying $10,000. I know, John, you've a few years ago you were saying $20,000 per ounce of gold. Tim, what do you feel that people are best doing? If we just have a little look quickly at the way retail investors, the people who are on this call right now, how they should be allocating their money. Grant has pointed out something about regular investing in stocks and shares, that sort of thing. Is that going to continue to be a good thing to do? What would you recommend that the average retail investor does percentage-wise with their investments?
If I look at how we allocate our own portfolios for private clients, then very roughly it would equate to something like, I mean, we're overweight tremendously probably versus our peers. So we've got something like 60% allocated to real assets and to commodities and precious metals, and then the balance is invested across, if you like, classic value stocks outside the commodities arena, and also a type of technical trading momentum fund strategy called systematic trend following funds, which accounts for now about probably 30% of our portfolios, but they're difficult for retail investors to get hold of. I think I saw on the chat that someone referred to the impact on say currencies and what happens when you get this kind of crisis. I think it's important to point out that the thing I can't emphasize enough is, for us, all of the risk is in nominal assets, in paper assets, in government promises, in paper promises. So whatever a portfolio should look like, I think the chances, the likelihood is that those portfolios that are most heavily allocated towards real assets, which I think the whole panel would agree are underpriced historically, that is going to do much better and will preserve capital in real terms better than probably anything else.
I've got another question here, interesting one from Kevin Lay, who says, am I correct in thinking that in Russia, Putin set their currency against gold at the start of the Ukraine conflict? If so, are things going well for Russia? I think they are going well, better there than they are here, frankly. John, what do you think?
I think what Putin did was, I think he stipulated that the central bank needs to have a minimum reserve holding of gold vis-a-vis the amount of currency in circulation. As I recall, it was something along those lines. And that's, don't get me wrong, it still gives the central bank tremendous latitude to do what they feel they need to do. But certainly, Russia has a significantly more gold-oriented monetary system as a result of that being an explicit directive, one that no other central bank currently has. I believe the last Western central bank that had very explicit guidelines regarding the minimum amount of gold that it needed to hold was the Swiss National Bank, but they dropped that quite a few years ago now, I believe. But Russia, in fact, is moving in that direction. And indeed, if this whole BRICS idea goes ahead, part of the agreement would almost certainly be that all of the participating countries' central banks, in some gold-backed alternative international currency to the dollar, would probably commit to allocating a certain portion of their gold reserves to be available for the necessary liquidity purposes to back some portion of their international trade.
Now, we're coming towards the end of the hour, which is a real shame because we've got a whole load of questions. I will try and get through, bits and pieces. Some of them are about things that we have spoken about already. But I will just go around the panel asking again, really, how you would recommend that people on this call, particularly, and those who are watching, how they go forward to protect what they have and ideally increase their holdings, given that inflation does seem to have been baked in right now. And I'll start with you, Cameron, because I know this is a theme of yours, particularly that inflation is baked into the system in the UK, or in fiat currency generally. And what do you recommend that people do to protect their assets and ideally increase and beat inflation going forward?
Well, what I designed with Tally was basically looking at it as a two-horse race. So in the UK, we can get bank accounts with pounds, or with Tally, you get an everyday account that's denominated in milligrams of gold, where the asset belongs to the customer. So in that two-horse race, if you've got lump sums, if you're looking for savings, protection and performance, I would open up a Tally account. But then you might suggest, I probably would say that as the CEO of Tally, but it's the simplest thing you could do right now. I'm sure there are some other steps you could take, but that's what I would suggest.
Tim, what about you?
I would, as I've sort of already alluded, I think it makes sense to have some allocation to physical gold, to physical silver, to miners, sensibly priced mining interests relating to gold and silver. We're starting to rotate now into other parts of the commodities complex, energy, for example. But I think to start the ball rolling, the purest form of asset protection is to own bullion.
Actual physical gold.
Yeah.
So, and it is helpful, particularly with sovereigns. You've got a tax advantage there, haven't you? Because there's no VAT and there's no capital gains when you sell them. So
because they're legal tender. But if we're talking meaningful sums, it's probably easier to use some form of a fund. And if you're going to go the fund route, make sure that it's physical allocated gold that's basically allocated to you and it can't be rehypothecated or lent out to anybody else.
how can you know that? Because this has been a problem with ETFs, hasn't it?
All funds worth their name should say in their prospectus exactly the terms in which you have ownership to gold. So you want us to say physical allocated gold.
Okay. And John, you've actually got an investment system that you are selling essentially at the moment, and I'm guessing that has a good deal of gold in it as well as other commodities, does it?
It does. What it basically does is it tries to create a generally diversified portfolio of stocks that trade at reasonable valuations and also pay reasonably high dividends and are reasonably low volatility stocks. So what that means is you just have a stable portfolio that generates an income, and that income should be able to at least keep up with inflation because dividends normally do keep up with inflation over long periods of time. So then that I usually aim for about to be 60% of the portfolio, and then 40% is dedicated to real assets of various kinds, including precious metals miners. And at the margin, over the past 2 years, within that 40% of the portfolio dedicated to real assets, I have favored silver because I did feel silver was absurdly undervalued vis-a-vis gold. Alistair's made the point today. You can also now make the case with base metals, but I felt that was the case with silver. One thing I would say is that silver, I think, still has some catch-up potential, but keep in mind it's usually 2 to 3 times as volatile as gold. So just be aware of that higher volatility if you're looking to allocate to silver.
Make good. And so people can get your system through your Amphora Substack, I'm guessing. Is that right?
Well, I provide it as part of a private consulting service, but I do make reference to it in passing in my Substack. That's correct.
And of course, when it comes to gold bullion, gold sovereigns, if you want to buy actual physical gold, then, and I have to mention our lovely bullion club. It's a big shame that Harry isn't here because he could talk about, the ease of buying it and storing it, etc. So I think, there are a number of places that you can get bullion and sovereigns from. Personally, I like the idea of having a mix of digital gold and actual physical gold. Both have pros and cons. So if you're wondering the best way to do it, I'd try and do a bit of both. And finally, Alistair, what is your recommendation to people to defend themselves? Because it feels to me at the moment that we're in the time of having to defend what we have rather than build up too much.
Yeah, that I think that's right. My view is that the days of trying to increase your wealth are gone. What you've got to do is try and protect your wealth. And protecting your wealth is a very, very different thing. So you come out of the momentum stocks, for example. You come out of things which are determined by credit in particular. And that's virtually everything, actually. As I said earlier, including physical property. The only way you can protect yourself, I think, is to get into gold and silver, physical, possess it. I don't go down the ETF route. The large ETFs are routinely used by the big banks as a source of liquidity to back their paper operations. So I wouldn't want to go into an ETF. And anyway, the costs, if you like, the management costs of an ETF are considerably greater than the storage costs of owning bullion. So I'm afraid it's very, very simple. And it's bad news for investment managers because they won't make any money out of what I reckon that people should do, and that is just physical gold, physical silver. And as you rightly say, if you look at sovereigns and also Britannia's, they are free of capital gains tax. And I think that's very, very important. And you can store those. In a reputable storage facility of one sort or another, or you can have, safe deposit boxes, which only you can get into. And this is desperately important because the government has legislation which allows it to access safe deposit boxes. But if you have the key, they can't get into it. So, there are the little wrinkles like this. I mean, this is I think almost sort of, I think it's very important planning, actually. You've got to be very, very careful so that what you have doesn't easily get into government hands as well. We're getting into, I think, a very difficult time. And I think the main thing is to understand what the hell is going on, which so few people do. I mean, we had a reference earlier to the crackup boom. That hasn't started yet, because actually what the crackup boom was, when everybody realizes that it's not prices going up, but it's the money going down. So they just get rid of all the money. They get rid of all the paper marks or paper pounds or whatever, bank accounts, in order just to get rid of it because it's going down. That is the crack up boom. We're not there yet. We really are not. So that, I think, is still ahead of us, unfortunately.
Thank you, Alistair MacLeod. Thank you so much for that. You can find Alistair on his Substack, the Alistair MacLeod Substack. Thank you so much, John Butler. John, you can find on the Amphora Substack. Tim Price, International Man of Mystery, is at Price Value Partners. And thank you so much, Cameron Parry from tallymoney.com. All of you have done a wonderful job. And thank you, all of you who've asked questions. I'm so sorry we didn't get to all of them, but we will be putting this up on the YouTube, on the Money Magpie YouTube. You can come and ask those questions in the comments there. We will be sending you the link. And of course, you can ask questions directly of, Alistair and John on their Substacks. Do feel free to join our Twitter as well, Money Magpie Twitter. You can ask questions there and we will reply. Or there's mine, Jasmine. I'm just Jasmine on Twitter, or Instagram, it's Jasmine Birtles. There are lots of ways to interact with us, so feel free to do that because we're always very interested in your questions. If you haven't already signed up to our YouTube, just go to Money Magpie and subscribe there, and you can ask all sorts of questions and see the podcast I did with Alistair a little while ago. Oh, and one with John and one with Tim. So there's quite a lot there. It's been great to see you again. Nothing that has been said here should be taken as financial advice, but we will be running more of these webinars. And if there's anything that you'd like us to have a webinar on, any particular subject, do ask us, and we will do our best to hold that because we like webinars. They're fun. I've been Jasmine Birtles, founder of MoneyMagpie.com. This has been the Money Magpie Invest webinar. Great to see you and hope to see you at the next one. Thank you. Bye-bye.